Well, thank you very much for inviting me. It's really a pleasure to be here. The last time I was at the German Post-Keynesian Conference, I was pregnant for my first son, who's here with me today, and I also have my second one, so it's kind of fun to be here once again after such a long time. And also, I just want to let everybody know that many of my mentors that have helped me grow up in the post-Keynesian tradition are here today. And so any issues you have with me, they really should be blamed for those things. But anyways, there are some obviously that are not here, but I want to acknowledge as well. So Randy Ray, of course, and Jan Kregel, and Alain Parguez, who passed away. So those are some of the people who really influenced me deeply, and I hope that you're going to enjoy. I'm going to be presenting a real MMT perspective, just hardline MMT, and I look forward. Yeah, I mean, I am. I'm not going to, you guys can pose questions and whatever after if you're interested in learning more about it. So, I was asked to do a presentation on what we do from these problems and how we would attack these problems from an MMT perspective. So, of course, we're facing really new challenges that we have not yet faced, and so it's a new thing for us. So I'm going to go through in my presentation, within an MMT framework, how do we talk about fiscal and monetary policy? And then how do we talk about fiscal and monetary policy coordination? Because that seems to be something that's really different from other post-Keynesian approaches. So I want to talk about that. And then I'm going to talk about it within the normal case. So like when we have higher levels of unemployment, lower interest rates, lower levels of inflation and stable political relations, like how do we handle these problems? So how do we engage in fiscal and monetary policy in those conditions? But then we want to also modify our conditions, right? Say, okay, well, right now we're not in those conditions. What is it that we're going to be doing if we have a low unemployment level, which is an issue that we're finding right now, high interest rates, high inflation, and an unstable political situation? So it's really like, let's put ourselves in a difficult situation and see if we can handle ourselves in this new situation. What would be the best course of action from an MMT perspective, and what would be our expected or desired outcome? So I'm going to start with kind of developing very slightly the MMT and also circuitist perspective on fiscal policy. So MMT is a direct derivative of circuitism, which is a school of thought that is post-Keynesian, considered post-Keynesian, and it comes from the French and Italian circuit tradition. So in this tradition, money is not looked at as an asset or a liability, or it's looked at as a flow. So there's a flow of money, a flow of credit into the economy, and a reflux. So there's a flux of money into the economy and then a reflux. So I want you to start thinking about money as a flow. And I think that all post-Keynesians really should start thinking about money as a flow, because this whole idea of the stock flow consistent models that we're all into, all of that is emphasizing the nature of money as a flow. So start from that perspective, and we can think about when the government spends, it's a new flow of money into the economy. So any government spending that occurs in the economy, it's a new flow, a new spending of money into the economy. So income increases in the economy, individual accounts are credited by banks, and deposits increase in the economy every time the government spends. It's not just sometimes when the government spends, but every single time the government spends, it's new spending that's put into the economy, fresh and new for the very first time, that increases income in the economy, and it's a new addition. Now, taxes, conversely, pull money out of the economy. So when people have to pay taxes, it's like the government is going into your pocket, taking the money that it gave you your grandmother. Let's say your grandmother got a Social Security check, a pension check. It put the money in her account. Well, now it's going into her pocket, pulling that money out, and then pulling more out of her purse, right? So what is happening when we have taxation is the reflux of money. So we can pretend that there's a line in the sand here. I'll be the government and you're the public or the society economy. So I'm going to put money in by spending and pull money out of the economy, the reflux, the destruction of money through taxation. So money increases in the economy when money is spent, through incomes policies or any spending. Like I could be buying helicopters or anything that increases the amount of money in the economy, and then taxation pulls the money out and that money is destroyed. So you can see how money is a flow. It goes into the economy and then is drawn out of the economy. Whenever government spending exceeds taxation, then we're going to have what's called a budget deficit. We call it a budget deficit. But you know, government is spending every single day. So today I'm going to be spending on helicopters. Today I'm going to be building new roads. Today I'm going to be doing this. So every day the government is spending. And every day people are paying taxes. So there's no one day like, oh, today we have a deficit. Oh, today. But we look over the course of a year, and about over the course of a year, the amount of money that the government puts in the economy relative to the money that it drew out of the economy may end up in a deficit situation. Okay? And if it does end up in a deficit situation, it means that more assets were added to the economy than were drawn out of the economy in the form of taxation. So we have a net addition of assets to the economy whenever there's a deficit situation. Now, firms and banks can hold these assets, these new assets. They can just hold them as reserves if they want to, but they can also hold them as cash, as any kind of liquid asset, or they can hold them as government treasury bonds. So there's all these different possibilities for them to hold this extra cash. But one of the possibilities is just hold it as reserves or hold it as treasury bonds. Now again, a deficit is only known after the fact. So we're going to look at the data after the year has passed and we say, oh, today, well, let's check today. Well, today it looks like we have a deficit. Okay, so we did have a net addition of assets to the economy. Now we can also look at the converse situation where government spending is less than the amount that it taxed. If we have a situation where the government put in a certain amount, pulled out more than that, went into our pockets and pulled out more of that money out of our pockets, then we're going to have what's called a budget surplus. So a surplus is a flow and it destroys net financial assets. So the money that had been placed in the economy to add has now been withdrawn from the economy. So there are fewer net assets in the economy than there were before. So assets are destroyed, and those assets can be that are destroyed are a combination of reserves, cash, and treasury bonds. So I'm sure many of you may be familiar with the US financial sector balances or the financial sector balances for your economies. But here I did it for the United States 1960 to 2020 Q3. And if you see, you can see the green line, it indicates the government sector deficit or surplus. And you notice that the general situation is that the government is generally in a deficit situation. And over the COVID period, so if you look at the end of the graph there, you see this like massive decline in the green line. That's the massive increase in government spending that took place as a result of the COVID crisis. And then you can see the actual mirror of that in the private sector assets that were created during that time. So for every asset, there's an equal liability. So if the liability is the creation of government debt, on the other side, who holds that, you know, what we call a hot potato, is the private sector. And the private sector assets grew proportionally to and almost equal in proportion to government sector deficits. I mean, the beauty of this chart, which is, is due to Wynne Godley and Mark Lavoie and other people at the Levy Institute, including Gennaro Zeza, you know, this indicates, this really shows you kind of like how one is a mirror of the other. You see, the private sector assets are mirrored in the government sector deficit. So now I want to kind of move into monetary policy. So when we talk about monetary policy in the United States, the interest rates are determined by policy actions, and those policy actions the policy action is to meet objectives, and in the U.S. Is price stability and maximum employment. Now, of course, in Canada and the European Union, there's only price stability. So I know in Canada, we are always like trying to fight to get them to include employment as one of the goals of monetary policy. So in the US, Federal Reserve will set the Fed funds target, the rate on reserve balances, and the discount rate. So I wanted to see what are the different rates right now and do a little comparison. So if you look here, you'll see the Fed funds rate, and this is the Fed funds rate is the rate at which banks who have deficient reserves at the end of the day, and the banks that have too many reserves, they'll like, go to the Fed funds market and borrow from one another. That interest rate that they meet at, it has to land between 3 and 3.25% right now in the US. The rate which is paid on reserve balances that banks hold at the Fed, so they might just leave their money at the Fed, those reserve balances are going to be held at 3.12 right now. And the discount rate is, the beggar banks who can't borrow from the Fed funds market, they're going to be borrowing directly from the Fed, and that is going to be 3.25. That's how much they're going to pay. So what this does is establishes somewhat of a corridor within which, base interest rates for the entire economy are set. So we have the central bank working and setting the interest rate for the rest of the economy. They set those basic interest rates and defend them, right, through open market operations in order to, and that sets the bar. And we say like it sets the hurdle over which, all profit that you want, if you need to make money, right, and you take out a loan, you have to be able to make at least this amount when you pull out the loan in order to be profitable, in order to be in the game, right? And so the idea is that if you could set the bar really low, like almost anybody could be profitable at the very low bar, but not everybody can be profitable when you put the bar very, very high. So the idea in MMT, and I think a lot of post-Keynesians will agree with that, we should set the bar very low. MMT, we should set it 0, But it's in order to make it possible for as many people who want to try to make money, who want to be making productive, investments, to make sure that they can do them. Now, in the European Union, I was just kind of putting together comparison numbers. In the European Union, the policy goal is price stability only, just like in Canada. And the European Central Bank sets the rate on the main refinancing facility, the marginal lending facility, and the deposit facility. So the main refinancing operation facility is the one which compares most closely to the Fed funds rate, and that is the rate paid by banks to borrow reserves for over a week. Right now in the EU, it's 1.25. The deposit facility rate is the rate paid on deposited reserves at the ECB, and that's currently 0.75. And then the marginal lending facilities rate is right now 1.5. So if banks need to borrow directly from the ECB, then they're going to be paying 1.5. So this is, an expression of the monetary policy, what we call corridors. So in the US, I put the dates next to it because I wasn't sure if they're going to change before, maybe they have like a big meeting before, and I wanted to make sure that, I got those dates in there. So if you look, the rate on reserves and the rate on the Fed funds rate and the discount rate create like a sandwich within which, base interest rates are going to be, operational. And these are defended, it's the rate on reserves and the discount rate. Same thing with the deposit facility rate, the marginal lending facilities. And one thing that I was really surprised when I looked at these rates is you notice how come the ECB rates are so low relative to the US rates? It's interesting. I'd like to know more about that. So this is something I might look into and figure it out, okay? And maybe you guys know. So how do fiscal and monetary policy work together within the US framework, and how do they work together within the EU framework? So federal government spending increases income in the economy, reserves are going to increase, and this creates a situation of what we call excess reserves. Now, we understand that the interest rate is the price of money. So if the interest rate is the price of money, if we have excess reserves in the system, this will temporarily push the overnight interest rates down. And so the Fed funds rate, there will be pressure for the Fed funds rate to go to its lower bound. Excess reserves represent net new financial assets, and those, again, can be held as reserves, cash, or they could be used by firms, banks, and other firms to purchase Treasury securities. Now, in the EU, it's very similar to the US. When federal government spends in the economy, this increases income in the economy. But at the same time, it will increase reserves. Because the interest rate is the price of money, and all of a sudden there's more money in the economy, just like if there was more of anything in the economy, this price goes down. So there's pressure when there's government spending to push the marginal lending facility rate down. Okay. Now, they're going to act in the market in order to maintain the overnight rate, but excess reserves represent, again, a net new addition to financial assets. And those are going to be held either as reserves, as cash, and they could be used to purchase EU bonds or national government bonds. So we can think about, now we have, what's fiscal policy from the MMT perspective, what's monetary policy from the MMT perspective, how do these work in the current and normal situation and current situation? So within the normal situation, we have like a little bit higher unemployment levels, low interest rates, lower levels of inflation, and really stable political or relatively stable political relations. So in this case, government spending can increase demand for certain goods or services or even financial assets as income, saving, and net wealth are increased. It can also increase purchases of government or EU bonds depending on the operating procedures adopted by the Treasury and the central bank. So in the US, any increases in Treasury bonds is usually very close to the amount of deficit, but the central bank could buy most of those bonds, so they would have no effect on the economy at all. Of course, government spending in either of these cases has absolutely no effect on interest rates because interest rates are a policy variable determined by the central bank. So here I made a chart showing US inflation and net federal government spending from 1962 to 2021. So I'm looking really close to the same period of time. And you'll notice that government spending is indicated by the green line, and you can see that massive increase in government spending at the end there for COVID. And then here you see the black line represents annual inflation rates. In the United States, we see that inflation went up and then it went down, and then at the end here during the COVID period, it went down. But I don't know about you, if anything, this graph looks like, especially during the COVID period, that government spending acted against the inflationary pressures in the economy, not in favor of the inflationary pressures. So you can see right away that there isn't a relationship between inflation and net government spending, at least in the US case, from 1962 to 2021. There's no indication of that at all in this chart. So in this current environment, so we understand what's going on with the normal situation, but what about now? What's happening now in the economy? So we're talking about the current environment. We've got low unemployment levels, high interest rates, high inflation, unstable political situation. So in this case, deficit spending, as always, creates net new financial assets. Then these assets could be held as reserves, as cash, treasury, or EU bonds. So that's the effect of deficit spending, to create net new financial assets. It may also increase demand for certain goods, services, or financial assets as income, saving, and net wealth are increased. We may also cause an increase, if we do deficit spend, we may also increase the purchases of government or EU bonds depending on how the domestic operating procedures occur between the government and the central bank. But again, it has absolutely no effect on interest rates. What we are seeing is the effects of low unemployment, the effects of production shortages and speculation, and the effects of high interest rates. So low unemployment can provide an incentive for us to start increasing wages, to put pressure for us to be able to produce and meet this greater temporary and new demand for goods and services. The production shortages and speculation in markets may increase the prices of certain goods and services. And the high interest rates, which were a policy choice, those are increasing the cost of production. Those increase the leverage in the economy. Those lower bond yields. Those may also lower demand for goods and services and financial assets. So maybe we could look at some alternative solutions. Why don't we treat the shortages and speculation and value work and productivity? So what different way of looking at the same problem would be to say, if we have production shortages that are maybe increasing prices for certain goods and services, if we have low unemployment levels that is maybe putting pressure on prices, then maybe these are some of the solutions that would be recommended from an MMT perspective. But also, I believe strongly, and I know that many of these actually would be perfectly advocated by Keynes. If you read his collected writings in the interwar period and even after the interwar period, you'll find all of these exact solutions in there. And so I want to look at it in more detail. But deficit spending should be encouraged to increase production in key areas, especially related to the production chain blockages. We should replace sensitive areas areas like energy with domestic production of energy. We should lower interest rates to encourage new spending in the key productive and employment-producing areas. We should encourage unionization to keep wages growing in line with productivity. We should reduce taxes to shift production to new areas. And then these are some, old school things that I found. Rationing can be used to help the pressure on prices. We may encourage postponed consumption. So instead of everybody coming out and spending their money right now, maybe we can say, like, you don't need to spend it right now. Patriotic saving provides special kind of bonds or something like that where people can hold on to their money for right now and you're going to provide them with some kind of incentive, and also regulate. So these are different possibilities that we have not even touched on. So, my main, problem with the way that we have handled, or not we, but people have handled the situations that we're facing, is that we use the solutions that were advocated and used by our grandparents. And when our grandparents were doing those solutions, look at the result that it gave us. Massive recession, depression of demand, through a depression of the global demand. Do we really need to do that? Aren't we better than that? Did we learn anything? I feel like we could do much better. So those are some of the things that bother me the most right now. So now we think about government deficits and debt. Remember, government spending is a new injection of reserves into the economy. Taxing destroys reserves in the economy. Deficit spending leaves more reserves in the economy than are drawn out. These excess reserves are going to put downward pressure on the interest rate, and any excess reserves can be used to purchase government bonds. What is government debt? So government bonds are offered to banks as a safe alternative to holding undesired reserves. If you're holding all this extra cash, you could choose to hold that cash in the form of a government bond, okay? These bond sales to banks, they drain undesired reserves from the system, and they help to bring that interest rate back up to hit the target overnight rate. So banks could then sell their treasury bonds to investors, or investors, if they have liquid assets, they might choose to hold a government bond instead of just holding liquid, low interest earning other types of assets, liquid assets. So the demand for government bonds really reflects a desire to hold a safe asset at a higher interest rate than the interest rate paid on reserves by the market or at the central bank deposit rates. What are the limits to government spending, deficit spending? So government deficit spending is not limited. More deficit spending will result in an increase in net financial assets. These can be held as reserves, as cash, or treasury bonds. New spending always results in more goods, more services, more jobs, more savings, and more treasury bonds, okay? So we get more out of government deficit spending. There are no financial constraints. The only constraints that exist are real constraints to our production. Okay. Now, what about the limits? You're like, well, that's nuts. What about the limits of government debt? There are no limits to government debt. Holding U.S. government debt is holding a safe asset. It represents a flight to safety during uncertain times. High government debt holdings by investors, they reflect a high degree of uncertainty, and they offer a hedge against that uncertainty. It's like giving a baby a soother. Here you go. It's going to be okay. I'm going to be back, okay? Real constraints to growth exist. I'm not saying that they do not exist, but these are not financial constraints. There are no financial constraints to economic growth. So here I made a chart showing federal government debt levels in the US from, again, 1962 to 2021. And you'll notice that we have the federal government debt, which is indicated by a green line. You notice that it grew quite a bit, right? And notice the non-correlation between the level of government debt and the Fed funds rate or the 10-year Treasury rate. So Treasury rate is going down. Fed funds rate is going down and government debt is going up. There is no correlation between federal government debt and interest rates. I hear you talking, it's fun. Okay. So in conclusion, you know, in our current situation where we have a position of, like, we're in a position where we have low unemployment, high interest rates, high levels of inflation, and a really unstable political situation, I would suggest that the best course of action would be to engage in more government spending, especially to increase production in the key areas related to production chain blockages. We want to replace sensitive areas that put us at risk. So these sensitive areas we're all familiar with are energy, and we want to start trying to figure out solutions that engage the domestic economy in that production. We want to lower interest rates so that we can encourage spending, in particular in the key productive and employment-producing areas of our economies. We also want to encourage unionization so that we can keep wages growing with productivity. And then reduce taxes in order to shift production to new areas where really the money is most needed. And then again, if we get to this place where it's still not working, I would suggest that we go to the, rationing, maybe postpone consumption, patriotic savings, and regulate. So those are some of the big ways that we can use the things that we know about already. And then we can start thinking about what are other possibilities. But clearly increasing the interest rate to combat inflation is maybe the worst of all the possible solutions to the dilemma. And it doesn't really treat the problem. It can actually make things worse. And so I guess my perspective is, why are we using the old tools that our parents used to deal with a problem that we could, be creative and use new tools to target the things that are really a problem? The problem is the speculation. The problem is increased prices and blockages in the supply chain. The problems maybe pressure in the labor market. So, we want to deal with those problems, not increase the interest rate and kill the whole economy. I think we can do better. So, in conclusion, increased government spending has beneficial effects long-term on inflation and production blockages. In the U.S., we just passed the U.S. Inflation Reduction Act. I don't know if where there's actually funding to different areas to relieve pressure on the supply chain, and there's also funding to replace energy with local domestic energy production. Do we have a EU equivalent? I'm going to leave that. Maybe my colleagues on the panel know that there's a EU equivalent or something similar happening here. Spending on the right goods and services can increase the supply side. We know that increased interest rates have really negative effects. Do we have a labor policy that touches unemployment and productivity? Maybe we should think about that and how that could be beneficial over the long term. These are kind of questions that I think like young post-Keynesians can be started to think about, and even the old guys too. Policies also obviously to alleviate issues in the Ukraine-Russia problem. So thank you very much, and I hope that you get like a little bit of information on how an MMT will look at the current situation and how we might handle the current situation. So thank you so much.